All right, ladies and gentlemen, MrSotko here. Welcome back to the channel. Got some crypto news stuff for you, but the first thing that I want to talk about is two things that could likely end us in a bear market for the foreseeable future. And I've talked about this a couple times in some of my live streams, but I figured I'd put this in video format. And these two things are not particularly good for investments. And on the horizon, there's really nothing particularly good in terms of what's coming in the news for crypto, because crypto really likes to move with the news. And of course, investors make those moves, but not until there's something good going on. We were at 10,000 some Bitcoin, and then PayPal news came out. Grayscale started to buy a whole bunch. MicroStrategy started to buy a bunch. Tesla came in and joined in the fray, etc. Pushed us all the way up to 64,000, 60,000 plus. And then all of a sudden that was taken away by the China FUD and Tesla basically taking away the Bitcoin payments, because Tesla bought $1.5 billion worth of Bitcoin, then accepted payments, which brought us from nearly 40,000 to basically 60,000 on that news. And then the news was sort of reversed, and we're back to where we were before Tesla actually accepted the Bitcoin and bought Bitcoin and accepted it for their cars. But there's two things on the horizon that definitely are not good. There is the Biden capital gains tax that he's trying to push in the American infrastructure plan. There's several plans, and they're going to go in different phases. Apparently now it's something like $4 to $6 trillion. And one of the things that he mentioned would be in that is a 40% capital gains tax. That's a long-term capital gains tax for millionaires. So if you make more than $1 million, then you would be subjected to a 40% capital gains tax. And while most of us may not be millionaires, it is the millionaires that have been moving the market and making the good news, like MicroStrategy, Grayscale, and all of these big institutions. And this goes for stocks as well. So when is this going to take effect? Well, probably when the infrastructure plan actually kicks in and they actually vote through this. Now, this article is from a little while back, but it's still trying to be pushed through, and I believe that eventually it will be, because there's really not much way to pay for this $4 to $6 trillion infrastructure package without taxing very heavily. So I believe that this is going to go through. Now, I did hear some speculation that this would actually be retroactive to April of this year, so back a couple months, and I don't think that's going to happen, because that would be like changing the rules in the middle of the game, and that's not particularly fair. I don't think people would really agree with that so much. Rather, it would likely start at the beginning of a new year, like 2022. Now, what that's going to do is effectively make everybody sell beforehand and then pick up after the new year, because it's essentially a tax break to sell early at 20% capital gains as opposed to 40% capital gains. So they're going to sell a lot of their fat, if you will. And this goes for the crypto world because it's still long-term and short-term gains respectively, and it goes for the stock world as well. So it just makes sense for people that are planning with a lot of money and a lot of assets to sell some of them before the end of the year, before this actually takes place, which is going to cause a massive crash in the market, in my opinion. Maybe not a permanent crash, but it's definitely going to lower the markets quite a bit, along with crypto. And then, of course, once this actually kicks in the new year, people can buy back in because there is no capital gains for just buying in. But I don't. What that's going to do is not leave more as people sell. So as people are selling and as companies are selling off their stocks and everything else, all their other assets, then they're not going to have as much left over because it's 40% capital gains, and they're not going to have as much to reinvest. It's not going to be good for the markets long term. And I believe if a Republican administration wins the White House, if you will, in 2024, this would certainly be reversed. It's probably one of the first things that Republicans would reverse because they like doing that and lowering taxes. So if this goes through, expect possibly a long-term bear market because this is just an outrageous tax. So investors currently pay 23.8% top rate on long-term capital gains. That includes a 20% capital gains tax held in taxable accounts for more than a year. It also includes 3.8% surtax on net investment income, which was created by the Affordable Care Act to fund Medicare expansion. And under current long-term capital gains are taxed favorably with respect to wages. The wealthy pay a top 37% rate on wage income, for example. So basically, short-term capital gains are so if you buy and then you sell a couple months later, it's just based off your income. So at the end of the year, if you made $200,000 total, including the assets that you sold, etc., you'll be taxed at the rate of somebody that would be taxed at $200,000 income. So whatever income tax bracket you happen to be in. However, with long-term capital gains, holding them for a year in the United States, it's 20%, which is far lower than somebody who makes a very low wage. So the wealthy pay top 30% wage on income. So you can see that 20% is far, far less. So it's a little strange how this is going to work. The White House plan would instead tax capital gains as ordinary income at a top proposed rate of 39.6%. It would apply to those with more than $1 million in annual income, although it goes on to say that there are possibly some exceptions for certain businesses, of course. A little bit of cronyism just sprinkled in there as well. So I guess they're just essentially going to do away with the short or long-term capital gains. And if you make more than $1 million, it's going to be 40%, basically. That's not good long-term for the markets, as when you sell and buy, you have less money to reinvest into the markets, and a lot more rich people are getting into crypto because of the gains, and that's going to stymie this quite a bit. Moving on to the next thing that is not so good for long-term investment, although this does not start till 2023. The Fed moves up its timeline for rate hikes as inflation rises. So the United States has printed something like 40% of all US dollars ever printed in the history of the United States in 2020, and I don't think 2021 is going to be much of an exception to that. And the inflation is rising faster than the Federal Reserve expected it to, which doesn't make any sense to me because they're the ones basically printing the money, so they should know, but right? They didn't expect it somehow. So it's rising much faster. Now, this goes to multiple countries as well. There are many, many central banks. Basically, every single country on the planet has a central bank, except for a couple or something like that. But so this goes for Germany, for France, for England, for basically wherever you are in the world. Basically, most countries printed a ton of money to make up for the fact that a lot of people weren't working and the COVID crisis, etc. And now we have this ridiculous inflation going on, and the Federal Reserve still has their rates at virtually zero, and they were going to raise them in 2024, but now it's going to be 2023. And when 2023 rolls around and those rates go up, that's going to be a lot less investment going on in the world. So you can see here that looking all the way out to 2024, even just with these two things, the rising taxes and the rising Federal Reserve interest rates are not going to be good for stocks and for cryptocurrency, as there's going to be sort of a deflationary dollar at that point instead of an inflationary dollar, at least a less inflationary dollar. And it's not going to be as good for Bitcoin and for investments, period. So the Federal Reserve on Wednesday considerably raised its expectations for inflation this year and brought forward the time frame on when it will next raise interest rates. However, the central bank gave no indication as to when it will begin cutting back on its aggressive bond buying program. However, this article is a little bit old, and I seen some videos where it was going to be 2023, as this article was written back on June 16th, and they've already basically said that it was going to be as soon as 2023, after saying in March that it saw no increases until at least 2024. So the so-called dot plot of individual member expectation pointed to 2 hikes in 2023. Though the Fed raised its headline inflation expectation to 3.4%, a full percent higher than the March projection, the post-meeting statement stood by its position that inflation pressures are transitory, which they later, after this article, basically said that it's maybe not transitory. It's a little higher than we thought it was. So I wouldn't be surprised if we were in double-digit inflation right now. It's always supposed to be 2, 3, 4% inflation or something like that, but I really don't believe that in any way, shape, or form, considering we printed literally 40% of all U.S. dollars in 2020, and that goes for probably your country as well. Maybe not as egregious, but certainly there's a lot of printing going on across the globe. But I wouldn't be surprised if this was double-digit inflation. So again, not going to be too good. But how can you get around this? Well, I'll make a video on that another time. But for now, of course, just buying DCA investing is usually the better way to do it, instead of just pouring all of your money at once and then having Bitcoin sort of go down after you did that. Not good. But DCA investing is just, 100, 200, whatever you can afford per week, per 2 weeks, per month, etc. And you just buy the same amount every time you buy, regardless of the price. It's usually the better way to do it. However, there's another way as well. Right now, there's BlockFi, Coinbase is offering interest rates, etc. And by putting your crypto in those cryptos like Algo and etc., and I'll make a list of those for another video another time. But there has been a lot of people on some subreddits and things like that saying that they're making pretty reasonable income right now by just putting their money into essentially interest stocks or staking, etc., or cryptos, and just essentially getting the interest rate and letting them sit there and just sort of piling more money into it over time, like DCA investing into those interest rate cryptos. Essentially staking cryptos, and that's just going to be passive income, and holding on to some of those for a few years until the 2024 Bitcoin halving wouldn't be such a bad idea. Moving on here, Binance suspends Euro bank transfers amid regulatory heat. So Binance is in trouble. Nobody is liking Binance right now, and they're basically suspending. The UK basically banned Binance, and now Binance is stopping Euro transfers. So regulatory constraints facing Binance have forced the popular cryptocurrency exchange to temporarily halt bank transfers denominated in euros, according to an email. Specifically, euro deposits via the Single Europe Payments Area, or SEPA, have been put on hold indefinitely due to circumstances beyond the exchange's control. Due to the events beyond our control, we are temporarily suspending euro deposits via SEPA bank transfers from 8 a.m. on July 7th. Although Binance didn't specify the reason for temporarily halting transfers, the decision likely stems from the onslaught of regulatory action taken against the firm. The most recent decision came a day after British financial giant Barclays announced it would no longer facilitate customer payments to Binance after financial regulators warned users that the exchange was operating in the United Kingdom without proper licensing. So we are disappointed that Barclays appears to have taken unilateral action based on what appears to be an inaccurate understanding of events. Despite facing backlash from the UK, Japan, Canada, and even the United States, Binance remains by far the largest cryptocurrency exchange in the world. However, I did read that they are not stopping debit or credit card transfers, but we all know those come with a little extra fee than those bank transfers. So Binance under heat right now, and I wonder if this is going to spread to other exchanges over time. Moving on here, Ethereum update to reduce Ethereum supply, likely coming in August. That's EIP 1559. So this is definitely coming. There was a bit of a backlash from miners as miners were making outrageous amounts of Ethereum. So Ethereum has a 2 Ethereum block reward, and the fees were so high that per block, miners were getting 7, 8, 9, even sometimes 10 Ethereum per block consistently for quite a while there, when a month or two back, when the Ethereum fees were super high. And of course they wanted to secure their income that way. And they sort of did some backlash and tried to have the Ethereum developers cancel this, but it is not canceled. It's going through. The next update on the Ethereum blockchain, which calls for changing how ETH is paid out to miners, likely coming on August 4th. The block number was officially proposed today on GitHub by developer Tim Biko, the Ethereum Foundation's point person on network upgrades. The various Ethereum client teams, the groups who code the various software on-ramps to the blockchain, agreed to the proposal. That target will become official. The date gives the multiple test nets enough time to finish completing the integration and hopefully ensuring there are no problems with the code. An error with the previous hard fork in April led to about 12% of computers on the blockchain temporarily unable to sync the network. We wanted to see how the testnet upgrades went before committing to a mainnet date. Now that 2/3 of the testnets have successfully upgraded, the last one is tomorrow, we're confident in setting a date for the mainnet. So what does this do? The two main things it does is essentially levels out fees. So the fee will be dynamically moved over time, and everyone will have the same fee regardless of the network congestion. So if the network is congested, that fee will go up for everybody, and if the fee goes down, that fee will go down for everybody. So no longer is there going to be like low, medium, and high cost fees in your wallets, etc., although you will still be able to set a fee, and that'll be in just a second here. So that's good. So at least you know what you're going to pay now instead of, just immediately going to pay and realizing, oh, it's going to be $28 in fees. At least you're going to know what that is in advance. Now, it's not going to lower the fees too much. However, it's going to regulate them, which is a good idea. Another thing it's going to do is burn the fees. So right now the fees are pretty low with Ethereum. You get 2 Ethereum per block, and when the fees are really, really high, it's something like 4, 5, 6 plus Ethereum extra per block. And when those are burned, that's going to make Ethereum deflationary, etc. Essentially. So if the fee of the block is more than 2 Ethereum, then that means that more Ethereum gets burned than gets created. So Ethereum will be slightly inflationary or slightly deflationary in that aspect. When the congestion is very low, it won't be deflationary essentially because there might be only 1 ETH fee, and you're gaining 2 ETH by the block reward. So a total of 1 extra ETH goes into the system. And that's an interesting idea. They think that it's going to be 1, maybe 2, 3%, something like that deflationary per year. So we'll have to see how that goes. But during times of high congestion, much fees will be burned. The third major thing that it does, so I said there was 2, but basically 3 major things, is that miners will not receive those fees. It'll just be burned. However, you can still tip miners. So, which is very questionable because you can't really get around this, because if the congestion is really, really high, then everybody will still be waiting on their transactions. Instead, you can now tip your miners and send a tip with your transaction, and yours will go through first. So basically, before we had a system where the highest bidder gets their transaction in first, and now we still kind of ironically have that, because during times of low congestion, there's no need to tip because everyone's transaction will go through at approximately the same time, just because there isn't a huge list or cache of transactions that are waiting to go through. But in times of high congestion, we'll still have that fee for speed, if you will. So people are going to be tipping the miners, and of course those are going to go through before yours does because you didn't include a tip. So there's really no way around that at the moment. So far, I guess they haven't figured that out. So that is still going to be a thing, only in times of high congestion. Although you could still tip a miner in low congestion, it doesn't make any sense to do that because there is no backlog of transactions that you would need to get in first. So it still exists, but at least it's settled down a little bit. Moving on to coin market cap here, $34,172 Bitcoin, 2,300 Ethereum, and $1.41 Cardano. So Cardano is still doing pretty well overall. The market doing fairly well, still trading sideways. The only concern I have is going under 30,000. Right now we have a lot of support at 30,000. We've dipped under 30,000 a few times in the past month or so, and it gets brought right back up above 30,000 pretty much immediately. So that means to me that there's a lot of support at that 30,000 and sub 30,000 range. However, if we keep doing that over and over, I believe eventually we're going to essentially run out of that support. We're going to run out of those buyers at that period. However, if it only does that once a week, that's not a problem at all. People are just going to be swing trading and buying it there and then selling and buying it there and selling as it gets to like 34,000 or 35, and that's not a problem. But if we stay under 30,000 for several days or something like that, we're going to run out of that support, and I fear that we're going to be under 30,000 for a while, and especially with these two major things coming up that could cause a bear market, then we might be there for quite a while. But that's all I have for you guys today. Make sure you like, subscribe, and share the video. That helps me out a lot. My social media in the description below. Give me a follow on that when you get the chance to do so. But as usual, I'll see you guys next time.